I'm of the opinion, and we've been talking about a demand-destroying event for a long, long time, that there's something coming for this August, September, October period, and that everything gets sold. And it might have a specific gold angle as well. What if all gold holders were told they had to vault suddenly with government-approved vaulting agencies, and that these things would register on the blockchain and they'd do a weekly audit and everyone there would be, have to pass certain certificates and they formalize money. Instead of getting your revaluation, which is an admittance of dollar debasement at 15 and 20 grand, like just about every second YouTuber is saying is going to happen.
For over a year, the financial world has been consumed by the possibility of a sudden, aggressive revaluation of gold. Prominent voices, George Gammon, Clive Thompson, and even Stanley Druckenmiller by implication, have discussed the endgame of fiat debasement, culminating in a state-driven repricing of gold to $15,000, even $20,000 per ounce. The thesis is simple. Under growing global debt, monetary authorities may be forced to acknowledge the erosion of purchasing power by anchoring currencies to a revalued hard asset. Add to this the chatter around central bank digital currencies, a growing substitution of sovereign bonds for bullion, and a consistent shift of physical gold eastward. But Francis Hunt, trader, technician, and sound money advocate, offers a sobering counterweight to the popular narrative. While he agrees with the long-term trajectory of gold as a store of value and monetary anchor, he sees a far more turbulent path in the near term. According to his technical models, the precious metals market may be approaching a demand-destroying event, a sharp and possibly coordinated drawdown that could affect all asset classes, including gold. And unlike many of his peers, Hunt is not calling for euphoria, he's calling for caution. At the heart of his argument is the concern that too many market participants are now leaning in one direction. Revaluation, vault-backed issuance, and tokenization, these once fringe ideas have become baseline expectations among gold investors. But Hunt warns that sentiment has turned excessively one-sided, and the technicals, as he sees them, aren't confirming the bullish momentum. In fact, price action around the recent $3,000 level suggests something is breaking down, not breaking out. Still, Hunt is not abandoning the thesis of sound money. His long-term faith in gold remains intact, but for now, the evidence he lays out, a failed breakout, harsh rejections, and overextended positioning, points to a possible short-term reckoning, one that could coincide with regulatory crackdowns, forced centralization of gold holdings, or even a tokenized vault system that absorbs private metals into the digital fold. For traders and investors alike, the coming months demand clarity, not conviction. In today's video, we break down exactly how Francis Hunt arrives at this view. Stay with us as we unpack his detailed technical case, contrast it with the dominant revaluation narrative, and explain what may lie ahead for gold investors as the macro tides shift. Be sure to like, subscribe, and share, especially if you follow the metals closely. Let's dive in.
Firstly, on gold. In fact, it's story best told with the journey, where people can see the footprints in the path. So if we're going to go long form on this and just go where we are, because there's a bit of a shock and a twist coming here. So if I pivot you to gold, I will remind everybody that we said this is one of the most important small HVF structures right here in the blue. And many people were sleeping on this particular breakout. They had suffered the indignity of a high at 2021, and they'd seen nothing but downside. The promise of the golden elixir, every time we just ran the 2K, downside. Just ran the 2K, downside. And we said once, twice, three times, fourth time a lady, like the Lionel Richie song. You may remember that. It's kind of a catchy phrase thing we use. And it goes with technical analysis. And we said this is going to turn into a winding up structure. This low leg was at $2,011. That was just after you were sitting on top of the 2,000 support. By the way, you can see the dark blue over here. Maybe I should get my traditionally popular transgender pink out instead. It pops a bit more. And I know you're all rooting for me to do that in Marxism times. Anyway, so when we had this set up, we said, listen, you're probably going to do a 293,000 run from here. Not only will you get the upside of this particular target, which I think was around here, you're going to stay largely going up right the way through, because this is all part of, and then we drew this larger. So we have patterns within patterns. This is how you build wealth, by the way. You multiply your way in there. You use a small pattern to break into a bigger one. And the leg, the flag-like leg, this is a broadening structure. It's not a channel, but the flag-like leg was giving us the 293,000 vibes. You can see those are the two zones there, 2,900 and 3,000 targets. And we said, that's going to be a good run. And then at some point, we need to take the temperature to see what's happening from there. And that was a very accurate and good call. We aren't always accurate. We aren't always going to be golden. We're talking about the future. Please remember, on balance of probabilities, we're scenario casting what might happen in the future. That was a great run that we had. There was long, strong periods. There was very short gestation periods, long, strong periods. Again, another squeeze, which we utilized. And here I want to get into the key bit, because we're in uncharted territory, and there we were, we ran the 3,000, so that was our target, and we say typically you get a bit of progress decay. There's the run of the 3,000, slam really hard at that point, but it didn't get follow through. In fact, something else coincidentally occurred at the same time. Decide for yourself. We had peak tariff tantrum. This was when Trump was going to tariff the world. He was fighting with Europe. He was fighting with China. He was fighting with everybody. And suddenly there was a mass disposal of US assets. The bond rates went up. However, instead of the usual hegemon events, the dollar crashed on that bond rates going up. And this was a sudden fruition of a prophecy we gave in 2022 in September, when we said the following: what happened for Liz Truss and Kwasi Kwarteng is going to happen for America. And you got a small peak microcosm event of that. Suddenly he backed right the hell off. At that moment that the dollar absolutely spilled violently, and we'll bring up the Dixie, we'll bring up the dollar just to show you that, we got a moon shoot. So this was at our target of 3K, 293K that we had predicted. You got a super spike moon shoot to 3.5. A logical round number as the midpoint between the 2000s. It got stamped on there, down, rally, down. A classic A, B, C, D structure, sort of Elliott wave structure. And then there was a bid at 3,120. So this is the story so far, what's happened. Initially, we came into this, we were super bullish. Those that are bias bull, fundamentally and technically, we're in an upside trend. We want to be bullish. Then typically, debt markets collapsing, we want to be bullish. My big concern now is we were very much in the minority down here on this structure. Everyone was, another dime at $22,000 again for gold, just run it, fall back down again. It was quite out there to be that bullish at that time. And to talk of a 50% move, don't forget, you're at 2,000. You traded 3.5. That's well more than 50%, but our targets at 3 represented essentially a 50% move. And you got the typical amount of overperformance thanks to the tariff tantrum and the politics and the collapse in the dollar. This last blow off, this little turbo final pop over here, was actually a function of the dollar and everybody suddenly waking up that debt is a problem. Now, we made a call in 2020 September on debt markets, and we've said a lot of things. We said the 40-year bull is over, and that was outrageous. Everybody was buy bonds, wear diamonds. Raoul Powell said it. All the other traders were saying it. You just had a major surge. Bonds had never been more valuable. This was, of course, the stock market crashed. Bitcoin crashed. A whole bunch of things crashed in CV19, as you know, and all that money ran into the fiat trade, which was debt markets. And we very shortly after that in September, so that was all March of 2020, said, actually, we've turned. And the pattern structure of that debt market is where we are now in gold. So I am initially going to shock everybody by saying I'm deeply uncomfortable with the way we got rejected on the last run. We thought there was a break. So I'm going to drop the time frame and I'm going to take you into gold because it's quite important everybody listens. Because it's going to cause a lot of hate. All our stackers, everybody are going to come out. They're going to want to beat up on me now. I am a long-term investor in precious metals. I am a sound money advocate, but technical analysis is technical analysis.
Francis Hunt begins his technical story not at the top, but from the trenches. Gold's price journey, as he frames it, is one of structural progression. Smaller bullish patterns giving rise to larger ones. A compounding effect that builds wealth slowly but decisively. His early call, made when gold was hovering at $2,000, anticipated a strong move to $2,900 to $3,000 based on identifiable HVF, Hunt volatility funnel structures. That prediction played out with surprising precision. The upside was helped along by geopolitical shocks, trade wars, and a weakening US dollar, events that catalyzed market reactions but didn't alter the underlying technical path. However, the critical shift came not with the surge to $3,000, but with what happened next. Gold failed to sustain the breakout. Momentum stalled, and a sharp rejection followed, what Hunt now views as a flag-like grind that lacked the symmetry of healthy consolidation. Worse, this rejection mirrors price action he identified in the bond markets before their last major downturn. According to Hunt, when a breakout fizzles with unusual speed and violence, it's not just a failed move, it's often a warning signal, particularly when sentiment is peaking and retail participation is saturating the narrative. And this is where Hunt's concern deepens. Technical patterns are one part of the puzzle, but market behavior completes the picture. He observes increasing social media excitement, analysts drawing overly optimistic symmetrical triangles, influencers predicting $4,000 gold, and investors universally buying the dips. This crowded behavior, when combined with waning price confirmation, suggests that the market may be setting up for a sharp, synchronized sell-off. And if history is any guide, such corrections are rarely contained. They bleed into other risk assets and often coincide with structural transitions.
Here's what I've noticed. Luke Groman, lauded in Zero Hedge recently last week, good analyst, by the way, talking about how there's a big substitution of bonds. The best explainer kills it, how the bonds are being sold off for gold. This got a lot of Zero Hedge. Now, by the time my technical trades start to get acknowledged by somebody else, because we are the Cassandras of this market, it's usually a concern for me. This happens countless times. Zero Hedge and other financial media. By the time they're talking it and bragging it, we were saying since the end of 2020, quarter 3, quarter 4, September kind of bridges the two, that this is a substitution. Now other people running with our messages are now getting lauded. We also had Stanley Druckenmiller saying they short bonds, that didn't say they were buying gold, but I imagine they might be. All of those things. We've had George Gammon, Clive Thompson all come out and say on YouTube that they're going to potentially re-rate to 15,000. George Gammon said to 20,000. All of this. This is only bullish, and this is all debt bearish, what Luke was saying, and gold bullish in the mood. And it's making me deeply uncomfortable. Then we got the technical price behavior that was going on here. When this we thought was a breakout, and we went and we were lauding it, and we were laughing, and we were also cocksure, etc., and happy days. We were net long here over there on a breakout. And it had fast-paced momentum. It was going all right. The subsequent, here's what happens when you're a technical analyst. When any time something out of the blue happens that is disproportionately unexpected and high momentum, we look at the rejection from the 3.5, that's the rate of decline. We look at our secondary rejection. If this was walking out and squeezing into volatility. The other thing happened on Twitter, everyone's drawing symmetrical triangles and has been following me for a while and is now going gold 4,000. And I'm going, too much of retail, all in this space. So all the sentiment indicators are making me nervous. I now draw the rejection to the low there. That is a steeper line of rejection. We don't like this. This was a bit of a flag-like grind up, and the hardest pattern to spot was our bond call short. And I'm going to tell you that this technical pattern looks exactly like that. And what tends to happen, because I spoke in the community and I mentioned it once or twice on YouTube, this buying line along the bottom was a bit steep. Typically, we like to see more symmetry. It's kind of flat along the top, but a bit steep along the bottom. So what tends to happen is more and more people have got the script and it says, buy gold on dips. So they're coming up under here, buying gold on dips. Coming up under here, buying gold on the dips. This leads to it being a bit high. Coming up under here, buying gold on the dips. Coming up under here, buying gold on the dips. Eventual breakout, complete fizzle back. It shouldn't have happened. I thought everything was hunky-dory. We're off to the races. 3,800s, 3,750s were a target, etc. Typical upside HVF breakout draw. Then I watched the selling and I go, this isn't right. It is hard, it is strong, and it's violent. Then I think of my reset. We're going into quarter 3, quarter 4. It's August coming, September, October. We've got a CBDC launch. We've got everyone bullish and talking about revaluation upside. By the way, small sidebar. Somebody who spoke of that revaluations to 15,000 said it wouldn't be inflationary. It absolutely would, because if gold's going to go to 15,000, silver would move in the private markets, even if it is not by decree remarketed, up to its ratio. You would get a similar move in platinum. Semi-precious metals like copper would have to move. And actually, rather than being a gold-based reset of price, it is an acknowledgement of a dollar-based debasement. That's what would happen. And you would actually start to see softs going up and you would get inflation. It's not a free 3.9 trillion to get. So I disagree with that particular person. So we've got too many people all expecting by decrees we're suddenly going to get a moon shoot. This started excessively to worry me. When I combine it with this price behavior, I'm going to show you our call that we made in the bonds and why I call them similar. Also, when you look at a big time frame on technical analysis, you start to see that actually you were a little bit higher in the middle. So I just got up a time frame. I'm just going to take some of the draws off. It's a bit messy. You can see this was quite a big shooting star, but at the candle levels, you were higher here, but you didn't go higher generally. This is more rounding out. So this was a bit of a superfluous, unique event on a spike that didn't hold. There was a baby's breath at 3,500. Forget trying to have sold at that point. You were very unlikely. It's probably negligible volume. And now you've had this. This is a big shooting star. To have gone that far and to be rejected that hard with a red candle body now, but it's a kind of that's a big shooting star. It was a turn. Now, does that mean I'm saying gold isn't sound money fundamentally? No. But I'm of the opinion, and we've been talking about a demand-destroying event for a long, long time, that there's something coming for this August, September, October period, and that everything gets sold. And it might have a specific gold angle as well. What if all gold holders were told they had to vault suddenly with government approved, and that these things would register on the blockchain and they'd do a weekly audit and everyone there would be, have to pass certain certificates and they formalized money. Instead of getting your revaluation, which is an admittance of dollar debasement at 15 and 20 grand, like just about every second YouTuber is saying is going to happen, either China's going to do it, or the Fed's going to do it, and they have all their gold in the vaults, all these things assumed. What happens if this turns into exactly what I just shown you?
Hunt's broader message is one of macro prudence. He acknowledges the mounting pressure behind revaluation arguments, debt ceilings, failing fiat, institutional gold accumulation, and sovereign disillusionment with U.S. treasuries. The substitution of bonds for bullion is no longer just an outlier view. It's becoming mainstream, endorsed by analysts like Luke Groman and echoed on Zero Hedge. But for Hunt, the moment a thesis becomes consensus is precisely when it's most vulnerable. Markets rarely reward overcrowded trades, and gold, despite its fundamentals, may be facing one of its most crowded sentiment peaks in recent memory. In his analysis, the sell-off from the $3,500 spike wasn't just a normal retracement, it was a structural red flag. Hunt traces an unusually steep rejection line, noting that each failed breakout is happening at lower highs with sharper downward momentum. Compounding this is the emerging likelihood of top-down monetary centralization. Hunt floats a scenario in which governments mandate vaulting through approved agencies, backed by weekly blockchain audits. This isn't a conspiracy, it's regulation. And it could fundamentally change the liquidity profile and ownership dynamics of physical gold. If such a shift occurs, it won't be a spontaneous repricing to $15,000. It will be a formalization of money that invalidates much of the revaluation hype. Gold's rise under such a framework might come, but not in the explosive, retail-friendly way currently projected. More likely, such a system would restrict price discovery and suppress free market premiums, similar to how central banks manage currency pegs and interest rates. Moreover, a gold revaluation wouldn't be benign. It would acknowledge dollar debasement and trigger price contagion across silver. Inflation would accelerate, not retreat. As Hunt concludes, this moment isn't about abandoning gold. It's about bracing for engineered volatility, policy intervention, and the painful clearing of overbought sentiment. The path forward may still lead to higher prices, but not before a sharp flush challenges assumptions and purges excess. In a market this politicized and this crowded, technical discipline matters more than ideology. And if Hunt's analysis proves accurate, gold investors will need both conviction and caution in the months ahead. If you found value in this breakdown, make sure to like, comment, and share your own perspective on where gold is headed next. Subscribe and hit the bell so you don't miss future deep dives on precious metals, macro resets, and the evolving financial landscape. Until next time, stay smart, stay hedged, and stay informed. Thanks for watching.